Greetings, Nick Defenthaler here with the Center for Financial Planning. Thanks so much for taking the time to join us today. I'm excited to talk with each and every one of you and share a little bit more about our thoughts of what folks should be thinking about when going through a layoff, or maybe you've recently received a buyout offer. I'm sure this is a time of uncertainty, a high level of stress. And so hopefully this educational session is helpful so we can help guide you to make some informed decisions, whether or not you do take the buyout offer, or if you have recently been laid off, give you some of the top 5 financial considerations that we think you should be thinking about during this time of uncertainty. A little bit about Center for Financial Planning. Our firm has been around since 1985, so coming up pretty quickly on our 40-year anniversary. Pretty cool, actually, because we have a lot of clients who've been with us since day one. So we're now working with even great-grandchildren of clients that we initially partnered with back in the mid-'80s. So kind of a cool thing how we've been able to serve generations over the years. Our team is comprised of 29 dedicated team members. Almost half of our team currently possesses a Certified Financial Planner designation, the CFP marks. It's extraordinarily important to us. We want each and every one of our lead financial planners to have those marks. Really think that additional education and training allows us to help serve clients in the most effective manner in the way that we think we should ultimately approach financial planning with clients. Our mission as a firm is pretty darn simple. It's improving lives through financial planning done right. So what does that mean? It's tackling a lot of other financial planning concepts that extend well beyond the investments. Certainly the investments and how you position your portfolio is certainly extraordinarily important. But as you're going to see today, as we go through some of the content, there's a lot of other things that comprise your financial well-being, whether it's health insurance, estate planning, taxes. And we just think it's a miss if your financial advisor isn't at least giving you some level of guidance in those areas. We have the pleasure of serving, I believe close to 950 families right now. We're located in Southfield, Michigan, also have an office in Brighton. And as we sit here today, currently manage just over $1.5 billion in assets. So a very large independent financial planning firm. Clients tell us all the time, we kind of have that family feel, if you will, compared to some of the really large financial institutions out there. You can really feel and see the difference when working with the center is something that we've heard over the years. A little bit about me. Once again, my name is Nick Defenthaler. I'm a partner and senior financial planner with Center for Financial Planning. Joined the firm in mid-2013, so been with the team for over 10 years now. Have almost 20 years of experience in the overall profession. I too am a certified financial planner, but also have an expertise in another designation really focused on retirement income planning. Me personally, traditionally working with folks who are within a couple of years of retirement or those who are currently retired. Doesn't mean that I never work with any folks who aren't quite there yet or maybe still accumulating wealth. But when I kind of take a look at the folks who I generally think that I add the most value to, if you will, it's how do we figure out how to put all of this together where you spent your entire career accumulating assets. Now we need to draw those assets down and turn it into a paycheck. So I have a lot of passion around that. And my number one goal when working with clients going through that transition is to hopefully make it as stress-free as possible. We're never going to eliminate the stress completely, obviously. But my goal is to give you the ability to delegate these financial matters to our team. That way you can focus on the things that bring you joy, meaning, and happiness. I currently live in Brighton with my beautiful wife, 3 young kids, and have been doing a lot of speaking over the years, whether it's for local or national news publications. Do a lot of educational sessions at local libraries, and it's our core value as a team to just educate and be a resource for folks. So once again, really do appreciate you joining the call today. And last slide before we really get into the content, I thought this quote from Vivian Green was just so perfect when thinking about a major financial transition, like receiving a buyout offer. Maybe you've unfortunately learned that you're being laid off. Life isn't about waiting for the storm to pass. It's about learning to dance in the rain. It's a lot easier said than done at times, right? But I would challenge you, if you are going through a transition like this, think back of all the things that have occurred in your life, right? There's probably several major life events that were extraordinarily stressful that you lived through, that when you were going through it, you couldn't even imagine what life was going to look like on the other side, but you got through it. And you'll get through this too. So really excited to be a resource for you today. Encourage you to continue to hopefully have the good attitude that you have right now. I can't tell you how many times I've met with clients who went through a transition like this. I meet with them a couple years later and they say, you know what, Nick, it stunk at the time. It crushed me to receive this news from my employer that I've been with for 20, 30 years, but it was the best thing that ever happened to me. It allowed me to retire a little bit earlier. I knew you told me I could, but I just never really thought that I was going to be able to. Or maybe they ultimately started a new career, opened up a small business. A lot of cool things can come out of this. So continue to have that great attitude and everything will work out. So the top 5 things that we're going to talk about, or I should say 5 considerations that we're going to talk about today. Number 1 is cash flow. Most important, in my opinion, during this time of transition. When you learn that you're potentially losing your job or either being laid off or taking up your employer on a buyout offer, most recently actually Stellantis, because as you know, I mentioned our office is located in the Metro Detroit area, have a lot of clients with the big 3. Stellantis just announced that they were going to be offering voluntary buyouts to about 50% of their workforce, over 6,000 white collar employees. You have to have at least 5 years of service to ultimately be in consideration of this sort of buyout. If you take Stellantis up on this offer and you've worked there between 5 and 9 years, you get 3 months of severance. That's the number 1 or the first bullet point on my slide there, right? If you've been with Stellantis between 10 and 14 years, you get 6 months severance. 15 to 19 years, you get 9 months. 20 or more years of service, you get a full year of severance. So obviously, that's the longer you've been with a company, whether it's Stellantis or any company for that matter. I mean, it's very common and typical that you receive some sort of severance. But if you haven't been with the company all that long, it might not be a huge one. So we got to figure out a way to fill that cash flow gap. Now, if you're going right into retirement, you were planning on retiring within a couple months anyways, this is awesome. This is fantastic. You just had a golden parachute almost, because if you're going to leave anyways in a couple months and now you're getting another 12 months of pay, great news. We really don't need to figure this piece out as much, because we can look at your overall portfolio and figure out how to recreate this retirement paycheck for you. But for those who are still working, maybe you got this notice in your late 40s or early 50s, whatever it may be. There are some options out there. So the one that and there's a lot on here, I'm not, for the sake of time, not going to go into detail on each and every one, but one that really sticks out to me that not a lot of folks are aware of is a special age 55 rule with a 401k plan. So if you are over the age of 55 and you have a 401k plan and you separate from service, and I'm going to generalize a little bit because there are some nuanced details, but I don't want to get too deep into the weeds here once again for the sake of time. But if you are over the age of 55, you have a 401k plan, you get laid off, you separate from service. If you leave money in that 401k plan and you take funds out, you can avoid, or potentially avoid, I should say, that 10% early withdrawal penalty that you would normally face if you were to take money out of an IRA, where you would have to wait until 59 and a half. So it's very common where folks are going through this transition where we say, leave that 401k as is. You're going to have to pay tax on the money when you take it out. You're never going to get away from that. But you would potentially avoid that 10% penalty that you would normally face if you rolled that money over to an IRA. So in some circumstances, clients who might retire, let's say 57 years old, keep that 401k as is. We're going to draw on that 401k for a couple of years. And then clients ultimately, when they turn 59 and a half or 60, they say, you know what, Nick, in the Center for Financial Planning, we don't want this other account hanging out there anymore. We want your team to manage that money. We want to roll that over into an IRA. Now that we're over the age of 59 and a half, we can take it out penalty free. So just a couple, nuances there. Not a lot of people are aware of that special age 55 rule. Depending on the types of dollars that you put into your 401k or your Roth IRA over the years, you might be able to pull some money out of those particular accounts, tax and penalty free. Once again, some nuances there, or potentially even borrow on life insurance. That not always, I don't love having to go here, but sometimes it's a necessary thing that we just have to do to get by for a period of time. Home equity line of credit, kind of tough to get one of those added onto your home if you just lost your job. So, but if you already had one established on your home, that could be a potential short-term cash flow source for you, if you will. Now, unfortunately, because of the interest rate environment that we're in right now, rates are really high on home equity loans, home equity line of credits, 8-9%, very common. So it's not ideal. Same thing with the securities-based line of credit. That's a unique sort of loan that is based off of assets that you own in an after-tax investment account. Once again, those rates are quite high right now. I've actually seen some clients take advantage of some really great low interest rate credit card offers where, let's say, if you put purchases on a credit card for a certain amount of time, you don't have to pay any interest on those purchases for 12 or 18 months. You got to be really careful with something like this, because it can almost seem like the funds came from what I like to call money heaven, and we never have to pay those back. So I don't love having to go here, but like I said, sometimes it's necessary. So make sure that, you know, you take a look at all your options. If you are going through transition and you don't have multiple areas to tap for cash flow, consult with your advisor, see what the best option might be in terms of leveraging some of the debt options that you might have. Okay. Next on the list, number 2 out of 5 is going to be healthcare. That's one of the top concerns that many folks have when going through transition. Now, I mentioned Stellantis a couple minutes ago. Haven't had a lot of details come out quite yet on, you know, what sort of package people are going to have related to healthcare. If there's going to be a continuation of benefits for a certain period of time, oftentimes that does occur. All right. So COBRA, that's a biggie. You basically have the same sort of insurance that you had with your prior employer if you got laid off or you're taking someone up on the buyout offer, but your employer is no longer subsidizing any portion of that healthcare plan. So companies have to be eligible for COBRA. Company has to have at least 20 employees. In most cases, you can be on it for 18 months, sometimes longer, and we'll go into all the details. And there's some unique health savings account planning opportunities. You can actually pay, if you have an existing health savings account, you can actually pay COBRA premiums from that HSA account. Not a lot of folks are aware of that. So if over the years you've built up a healthy balance in your HSA account and you find out, gosh, my COBRA payment's going to be $1,000 or $1,500 a month, how the heck am I going to pay for this for a couple of years, maybe before I go on Medicare? But let's say maybe you have 30 or 40 grand saved in that HSA. Could be a great place to look to pay for those premiums. So that's somewhat of a unique thing that not a lot of folks are aware of. Health insurance exchange. So for healthcare.gov, open enrollment, you're allowed to go on or find new coverage, if you will, due to a life-changing event, death of a spouse, you get married, you lose a job, etc. You don't have to wait until typical open enrollment time, which is usually around in the fall timeframe. Okay. This is for folks who are not yet 65. Okay. Not yet 65. Because when you're 65, you go on Medicare. All right. Insurance portability. I talked a little bit. Now, this is kind of related to healthcare, but drilling down a little bit more into the insurance umbrella, if you will, insurance portability related to life, long-term care, and disability. Many life insurance policies, disability policies, even some companies offer a form of long-term care coverage. You're able to bring those with you if you separate from service. So definitely something to ask your HR department when you're going through this period of transition to at least see what your options are. If you don't ask, chances are those forms of insurance are going to completely lapse. And let's say you're not in the greatest of health, and you have the ability, because you've already obtained life insurance, and typically when you have group life insurance through an employer, you don't have to go through underwriting. So let's say unfortunately you're not in the greatest of health and you've always had this life insurance, maybe a couple $100,000 or more. If you don't bring this with you, you would have to go out and go through underwriting, and there's a good chance that you might not be approved. So having that portability aspect to bring those coverages with you could potentially be a great option. Make sure you ask your HR department about that piece. A few things related to Medicare. And I mentioned that a few minutes ago. You go on Medicare when you turn 65, all right? Medicare, the way that Medicare works is once you turn 63, they're taking a look at your income to see how much your premiums are going to be. All right. So Medicare has this quote unquote 2-year look back period on income. So let's say that you turned 65 in 2024. You're going on Medicare. Medicare is taking a look at what your income level was in 2022 to determine your premiums for 2024. All right. And if your income as a married couple is below $206,000 in 2022, or $103,000 if you're single in 2022, you don't pay any more than that $174.70 that you're seeing for Part B. All right. It's what I like to call the baseline Medicare premium. However, if your income is above that, and as you can see, it goes up and up and up. If your income is significantly higher than the 206, you can end up paying a heck of a lot more for Medicare. However, let's say you turn 65 in 2024, but you retired in 2023. So 2022 is really not a great indication of what your income is today. That's considered a life-changing event. You can file an appeal for Medicare to look at your income, show them some documentation, say, look, I retired. I'm no longer making $250,000, $300,000 a year. My income that shows up under my tax return is actually about $150,000 as a married couple. So I should not have to pay a very high Medicare Part B and D premium. So that appeal could really come in handy, I should say. One of the services that our team always offers is connecting you with a health insurance expert. It is not our core area of expertise. We do, in fact, do a lot of income planning, particularly for those who are not quite 65, because there can be some unique planning opportunities to, if we're effectively managing how much income shows up on your tax return, you could actually end up paying a heck of a lot less for medical insurance prior to going on Medicare. So that's our wheelhouse in terms of trying to figure out how to really structure your income in a favorable way. We're not the expert in knowing what sort of coverage you should have given, the network that you're in or the prescription drugs that you're on. But we have folks that we can refer you to that will take really good care of you, and that's what they do each and every day. And we collaborate with them to make sure that you're getting the best advice possible. So that's just an additional thing that we offer for clients that I think helps deepen some of the value that we add for folks. The third piece is tax planning. This is a biggie. I will preface the conversation and say our team does not prepare tax returns, but we do a lot of tax planning and collaborating with client CPAs. Our number one goal is to reduce your total tax bill over your entire lifetime, not just for the 1 year, And so philosophically, we love working with CPAs and clients who have that same thought, where we're not just laser focused on the 1 year, we're taking a look over a longer period of time, because we think, if we're able to do that, we're going to save you a heck of a lot more money if we're focused on the long term, as opposed to, just that one current year. Typically, if you're receiving a severance, a company will withhold a flat 25%. It's very, very common. Now, sometimes you might be able to contact your HR department and say, hey, I want a little bit less withheld, I want a little bit more, whatever it may be. But it's not uncommon for that withholding on the severance to be significantly more than what you normally pay, or that you normally have withheld out of your check. If that's the case, chances are you're going to receive a refund at the end of the year. I think a lot of folks have this misconception that, I got this bonus or I got this severance and it was taxed at such a high level, like it has some sort of different income tax implications, if you will. That's not the case. Most companies just withhold a higher amount because they don't want to put you as the employee in a position to go and do your taxes only to find out they didn't withhold enough. Now you got to owe some money to the government. So maybe collaborate with your CPA a little bit if you're going through this and just make sure, hey, is this the right amount that we should be withholding? Tax bracket maximization. This is something we spend a lot of time on with clients each and every year to do some income tax planning to say, is there an opportunity to accelerate income when income is low? There's an anomaly year, as I like to say. And so if you're being laid off at a particular year and you don't have 12 or 18 months of severance, then there's a good chance that your income is dramatically lower than maybe it normally is. So in that situation, it could make sense to explore something called a Roth IRA conversion, where we take money out of existing IRA assets, we move them to a Roth. That amount, let's say it's 20 or 30,000 that we do a conversion, it does show up on your tax return. But if your income is significantly lower than we expect it to be in the future, it could be a great opportunity to pay the tax now, bite the bullet, but you're paying that tax at a much lower rate compared to what you would do in the future. Something to consider there. On the flip side of that, some clients who, let's say, have worked the full year, I worked with a couple clients who were with General Motors earlier this year, who took GM up on a voluntary buyout. Their income, was very high as it is. They got paid out a bonus, they got severance. So their income actually ended up being significantly higher than what it normally would be in a given year. So in that situation, we don't look to accelerate even more income and do something like a Roth IRA conversion. That would not make sense. What does make sense is trying to maximize deductions as much as we can. So one strategy that comes to mind immediately for those who are charitably inclined is bunching or lumping, so to speak, charitable contributions. So if you normally give away $10,000 a year to charity, but your income is double than what it normally is in a given year, and you're getting really close to retirement, why not, quote unquote, front load those charitable contributions? Not everyone has the ability to do this. Not everyone feels overly comfortable doing so. But let's say we want to essentially front load 10 years worth of charitable contributions. You normally give away 10 grand a year. Let's take a look and gift securities out of your after-tax brokerage account, ultimately maybe to a donor advised fund or directly to a charity for $100,000 instead of $10,000. Now you don't need to make charitable contributions for the next 10 years. And the benefit of that is we want to maximize deductions when you're in that higher bracket. Number one, to make sure that you're getting the best bang for your buck on the deductions, but to also make sure that you're exceeding that standard deduction amount by a fair amount. I could probably spend 20 minutes talking about just that strategy, but what I want you to come away with, bottom line, when I discuss this is, if income is significantly higher because of the layoff or buyout, I know it might seem kind of counterintuitive at times, but it happens, maximize deductions. Seek any way that you can. Maximize those deductions. Consult with your financial planning team and your CPA. If your income is significantly lower, which is the more common theme when you're going through a period of financial transition, take a close look at accelerating income through potentially a Roth IRA conversion. Our fourth item, retirement savings planning. What do we do with these 401k plans? Or, I have a pension, I'm going to get a lump sum, or a monthly income stream. What the heck do I do here? There's a lot going on. So got a couple different options with your 401k. Most folks have these when they're working over the course of their career. You're putting money in, you might get an employer match, et cetera, right? Got a couple different options when you retire. Cash that 401k out. I don't know if I've ever recommended that to a client, especially for those who have a significant balance. Let's say the client is 60 years old and they have $1 million in their 401k. If that client just says, you know what, write me a check, I want to put that money in my bank account, guess what? $1 million shows up on your tax return as income. Almost never do we want to do that, okay? You could roll the money over into a new 401k plan if you're not retiring. The issue, not all 401k plans allow for rollovers into the new plan. That's a consideration. You could keep that 401k as is. Many plans allow you to keep that 401k for a period of time, maybe forever. Or you could do something like an IRA rollover and say, you know what, I want a team, my financial advisor, to oversee this money that I've worked hard for over the years. I'm going to move that money from my 401k over into an IRA. I can then have that financial planning team analyze, the investments, make informed decisions, proactively manage it. It's a little bit easier to do that sort of thing in an IRA compared to having it in a 401k. So in many cases, at least, but you have to weigh all of your options, right? Cost in the 401k plan, cost of having a professional manage the funds. All of these things are important considerations. Kind of piggybacks or segues, I should say, into this next slide here. So, with a 401k account, like I mentioned, if we look to the far right underneath cons, huge tax liability if you just cash it out. You got to take into consideration, the cost of professional management when working with clients. The way that our team gets compensated, just so you're aware, we get paid a percentage of assets that we're managing for folks. For new clients that we're working with, we generally don't have any sort of commissions or things of that nature. There are no trading fees. We're really sitting on the same side of the table as you. And the way that things work is ultimately when your accounts are doing better, our team does better. And so I think back to 2022 when the market didn't do so well, clients' portfolios didn't do so well. Guess what? Our revenue as a firm was down. So we're in it with you together. We want to grow the money just as much as you do and make sure that you have a successful retirement and can achieve the financial goals that you have as a family. As I mentioned, that age 55 rule with the 401k does not come into play with an IRA. This is really I think I don't know if I teed this particular slide up all that well. This is kind of taking a look and saying 401k options. I think I missed the one. So this is 40k account options. I apologize, but 401k options kind of comparing to an IRA or an IRA rollover, if you will. So as I mentioned earlier, you don't have that special age 55 rule with an IRA. That's a consideration. You might have some additional creditor protection in the 401k plan. Some advantages to the IRA. Generally, you have a lot more investment options. In today's low interest rate environment, high interest rate environment, I've been trained over the last 10 years to say low interest rate environment, but there's some really strong rates right now in treasuries, CDs, individual bonds. Usually you don't have those at your disposal within a 401k plan. Those are some things that we've been taking a really close look at and potentially implementing for clients in their portfolios. Doesn't make sense for everybody, but it's one thing that I can think of right away, especially in that fixed income or bond component of a client's portfolio that generally just maybe get some better options or, at least more options within the IRA. Potentially have some professional and proactive asset management. And then another unique factor with an IRA, you can do something called a qualified charitable distribution from this particular account. You cannot do one of these in a 401k or 403b, et cetera. It really doesn't make a whole lot of sense to me because they have the same sort of tax treatment, but the IRS sometimes has some goofy rules. So once you attain age 70 and a half, you can actually gift funds from your IRA directly to charity, which is an extraordinarily tax efficient way to facilitate your gifts, especially once you have to take money out of your IRA. Right now, that age can kind of vary, but for most folks, it's 73 right now is the age that you have to start taking out RMDs, those required minimum distributions. Let's say you don't need to live on that full RMD, that amount that the IRS is making you take out, but you're charitably inclined. You can actually gift money from that IRA, and that means less money would have to show up on your tax return because of that RMD, which could be a really good thing because guess what? Your tax bracket is obviously based on your income. And the other component that's based on your income that we looked at earlier is your Medicare premiums. So I have a lot of clients who take advantage of that QCD strategy when they're in their 70s, helps save them a lot of money on tax and their Medicare premiums. When it comes to deciding, hey, I got this pension offer. I'm able to either take $1 million and roll it over to an IRA or as a lump sum, or I can have a $50,000 a year income stream, just throwing a number out there. Who knows what it would be for your situation? That's a monumental decision that you only have one shot at getting right, let's say. And so we want to take a really close look and say, how does that decision factor into your overall financial picture, your goals, your risk tolerance? All of these things are huge factors. I will say, generally speaking, when we're in a lower interest rate environment, lump sums traditionally look a little bit more attractive compared to monthly income streams when it comes to that overall offer. And even if that's the case, it sometimes does not make sense for someone to do the lump sum. Maybe they need, and just psychologically and behaviorally really want to have that set monthly amount, even if that lump sum looks really attractive. What I always say, and part of why I love what we do so much, is because yes, a lot of this stuff that we're talking about today has a lot to do with math, right? So we're all numbers geeks who do what we do. But there's this other thing called the human element that oftentimes goes far and above what the math will tell us. And I have no issue telling a client saying, hey, I think emotions are getting away from making a good decision. But if I think a client can't make a good or make a bad decision either way, I always say, what's going to help you pass the pillow test? And the pillow test to me is what's going to help you sleep well at night, or the best at night. So combining those two things, I think, is really what makes it somewhat of an art form of what we have the privilege to do for clients. So higher interest rate environments like we're living through right now make the monthly income stream look a lot more attractive, right? This is so unique. There is no black and white answer. What we like to do is, when we're trying to help a client make this decision, what other income sources do you have? What is your Social Security going to look like? What is the longevity in your family? Do you have a spouse? Is there a big age gap? You can't just look at this decision in a vacuum, in our opinion. You can when you're determining internal rate of returns and things like that, but that's just one component. We have to take a look and say, let's make a personalized plan to make sure that we're not getting this wrong for you, because the math might tell us one thing, but then there's these other factors that come into play that can not make the math look all the same. So hopefully that makes sense. We spend a lot of time on this with clients. We've done this for hundreds of folks over the years. If you have questions, reach out. We're happy to be a resource. What I always like to call the retirement red zone, and thinking, finalizing the conversation on the retirement savings aspect here, I would challenge each and every one of you who are listening today, go into your 401k or reach out to your financial advisor and see what your current asset allocation is. Strategic asset allocation, which really is just a fancy way of saying, what do you have in stocks and bonds? For many of the clients that we work with who are in retirement, that number is anywhere between 50 and 70% in stocks, with the remaining amount in bonds. Bonds, which could comprise individual bonds, bond mutual funds, CDs, treasuries, things like that. Stocks could be individual stocks, exchange traded funds, low cost mutual funds, et cetera, et cetera. You need to know what that is. I can't tell you how many times I start having a conversation with a new potential client, and little do they know, they're 80 or 90% in equity, okay, or stocks. And they're one bear market away from not being able to retire when they want to retire. When I think back to COVID, the S&P 500 fell 35% in a matter of about 2 weeks. These things can happen quickly. Now, thankfully, the market recovered very quickly as well. That does not always happen. Oftentimes, it can take 2 or 3 years. So what we like to do is, in the years that you're getting really close to retirement, a couple of years leading up and a couple of years into retirement, this is what we like to call the retirement income, or the retirement red zone. So what can we do to reduce risk? And if the market does really good, full disclosure, we might leave some money on the table. But for most clients at that point in their career, the risk is not losing out on some additional market returns. The risk is having it go the other way, not being able to retire when they want to retire. So maybe having a little bit more in bonds, having more in high yield money market positions where If you're taking money out of the portfolio, we don't need to sell stocks at an inopportune time, or at least we can sell less stocks. So there's a lot of different ways that you can do this, but sequence of return risk or timing risk, just retiring at a time in the world or the market where the market's not doing all that great, is a real thing. And so, I would challenge you, ask your advisor or look at your 401k, see what that asset allocation looks like, especially if you're getting very close to retirement, and take this into consideration because it could go the other way. And we want to make sure that you're protected and that you can still achieve those financial goals that you have. Okay, last but not least, putting it all together. We talked a lot about various topics today. When you're going through a period of transition, any sort of life transition, and we experience this all the time with clients, losing a job, death of a spouse, divorce, marriage, birth of a child, whatever it may be, grandkids, there's a lot going on, right? Not everything needs to be a priority right this second. So if you're going through a career transition, we like to build out something called a now, soon, later list and use this approach with folks. So as an example, right now, if you've been recently laid off, really take a close look at your budget. Make sure the health insurance is secure, file for unemployment, look at that 401k allocation, see if your insurance is portable, life insurance, disability, like we talked about. On the soon list, things like the life insurance, I got ahead of myself. This would maybe be on the soon list. It would be, the life insurance or the disability, things like that, maybe some year-end tax planning opportunities. And the later might be saying, does it make sense to keep my money in the 401k? Should I move it out elsewhere to a new plan, into an IRA, whatever it may be? Maybe something for the pension, the lump sum. This is very hypothetical, and this is going to look and feel, this list is obviously going to look and feel different for each individual. But in our experience, if we just give you one list and there's 10 things on there, you're not going to make a lot of progress on it. You go into that paralyzed state because there's just so much on there. We will help you prioritize that and say, these things are important. These 7 things are important. But guess what? We don't need to worry about them right this second. Let's focus on these 3 or 4 items and get them done. Once they are completed, we'll move on to the next. So we really like to be that accountability partner to help you through that transition because it's a lot and we fully recognize that. So in closing, covered a lot today, as I mentioned. Hopefully, I've been able to demonstrate that there's a lot more to your financial well-being that extends beyond just this investment management piece. It's obviously a big part of what we do for clients. It's extraordinarily important, but we really take that holistic approach to make sure we're hitting on all these different areas. And we don't always hit them each and every year, but at some point we will. And oftentimes there's a big decision that needs to be made in one of these areas that you can't afford to get wrong. So I really do appreciate everyone taking the time to join me today. Hopefully you found value in this conversation. Our team and I are here to be a resource for you, plain and simple. If you would like to have a conversation, feel free to reach out. We always offer, a 45 to 60 minute, 1 hour complimentary consultation. Even if we don't end up working together, that's fine. We want to make sure that we're pointing you in the right direction. And I can almost guarantee you that you will end up walking out of that meeting, even if we don't end up working together, feeling better about your situation, and we'll give you some great advice. So thank you again, thank you again for attending. Really do appreciate it. Hope you have a wonderful day and hope to hear from you soon. Take care.